Thank you for taking time out of your busy schedule today to watch the presentation video on United Urban Investment Corporation's financial results for the 43rd fiscal period ending May 31st, 2025. My name is Batai, President and CEO of Marubeni Reed Advisors, the asset management company for United Urban. We would like to express our sincere gratitude to all unit holders and other parties concerned for their continued support of United Urban. This financial results presentation video was created using generative AI, like last time. We will continue to actively adopt evolving digital technologies to enhance the accuracy of information in a timely manner and strive for the efficient operation of United Urban. I will now talk about the financial results. The Japanese economy continues to experience yen depreciation and rising prices due to the Bank of Japan's policy interest rate hike in January 2025 and rising inflation. However, income levels are improving due to wage increases by companies, and the Japanese economy is maintaining a gradual recovery. Despite uncertainty in the social and economic environment, the real estate market has generally remained stable, with office vacancy rates remaining below 5% and rents trending upward. Demand for residential properties and retail facilities remains solid, and the monthly number of inbound visitors in April 2025 reached a record high, boosting the performance of hotels and retail facilities. As a result, the overall real estate rental market remains robust. In the stock market, the Nikkei stock average has remained stable even after reaching a record high, while the J-REITI market has begun to show signs of recovery, but has not yet returned to its previous levels. United Urban's operations remain solid, but the investment unit price is still in the process of recovery. We will continue to make every effort to achieve sustainable growth moving forward, and we kindly ask for your continued support. Next, I would like to explain the progress we have made in terms of our medium-term growth strategy. Please see page 3 of the material. The goal of United Urban's growth strategy is to maximize value for its unit holders. Under our strategy for the period from 2025 to 2027, we aim for an annual DPU of over 8,000 yen and sustained increase in NAV. To achieve this, we have set the following 3 policies: asset replacement, profit increase, and cash allocation. Regarding asset replacement, we have decided to sell properties totaling 22.1 billion yen from December 2024 until today, aiming to return 1.7 billion yen in gains on sale and improve the quality of our portfolio. In terms of portfolio revenue, rental profit was up by 6.5% year-on-year due to increased rental revenues in the current inflationary environment and the effect of asset replacement. In terms of cash allocation, we maintained our strong financial base while keeping an eye on the market conditions, implementing property acquisitions, and buying back investment units. I will now elaborate on the details of our basic policy. First, I will discuss asset replacement. Please go to page 4. As part of our plan to replace approximately 10% of our AUM, or 60 to 90 billion yen, over the next 3 years, we have decided to dispose of properties worth 22.1 billion yen and acquire properties worth 25.3 billion yen. Regarding disposition, we carried out strategic replacements of properties with profit concerns due to changes in the market environment or those that are older and unlikely to improve profit going forward. This improved the quality of our portfolio and returned 1.74 billion yen in gains on sale, thereby increasing DPU. Moving forward, we will promote asset replacement for 11 properties as an acquisition pipeline worth approximately 80 billion yen to improve DPU and portfolio quality. Please continue to page 5. In terms of internal growth aimed at improving profitability, rent profit increased by 31.3% over the last 4 years, far above the increase in asset size. This was possible because of rent increases for existing properties and asset replacement in an inflationary environment. The increase in inbound tourism has driven the growth in rent revenues of our hotels, and we have maintained high occupancy rates through our continued hands-on management and diverse leasing strategies, while also raising rents. In addition, we have carried out asset replacement by shifting from low-performing properties to high-performing properties, thereby increasing profits from our rental activities and expanding the profitability of our portfolio. Please turn to page 6. I will now talk about cash allocation. We will use cash on hand with capital efficiency in mind and make flexible decisions on property acquisitions, unit buybacks, and early repayment of borrowings. During the current period, we sold 5 properties and were able to increase DPU from gains on sale. We also acquired properties that contribute to DPU growth in consideration of the implied cap rate, using the book value equivalent of the sold properties and the proceeds from debt financing. Because our investment unit price has remained at a ratio to NAV between 0.8 and 0.85, we carried out the acquisition of own investment units from November to December last year. This unit buyback totaled 50 billion yen, which exceeds 1% of our market capitalization and had a sufficient effect, raising our DPU by 47 yen in each fiscal period. Also, we will consider early repayment of borrowings and their payment dates, LTV level, and other factors in accordance with our financial condition. Next, I will talk about our distribution policy based on these initiatives. Please refer to page 7. The annual DPU from December 2024 is expected to reach a record high of 8,110 yen, representing a year-on-year increase of 7.2%. This increase is driven by asset replacement effects and improved revenue from existing assets. Therefore, we will likely achieve the annual DPU target of over 8,000 yen set in our medium-term growth strategy. Going forward, we will continue to make every effort to further grow the annual DPU by improving portfolio profitability through asset replacement, return of gains on sale, and increasing rental profit from existing properties. That was an update on the progress of our medium-term growth strategy. We will continue taking these initiatives to increase unitholder value and maximize returns to our unitholders. Now, I will explain the change of the sponsor of the asset management company. Please refer to page 8. In July 2025, Marubeni Corporation, the sponsor of the asset management company, and Daiichi Life Holdings Company, Limited, consolidated their domestic real estate businesses. As a result of this consolidation, the two companies each hold a 50% stake in the newly established Daiichi Life Marubeni Real Estate Company, Limited. This newly established company is now the sponsor of the asset management company. In addition, with the Daiichi Life Group joining us as a sponsor, we can expect strengthened sponsor support, an expanded sponsor pipeline, and enhanced capital policies, such as the acquisition of investment units. Please turn to page 9. I will now explain the real estate value chain within the sponsor group. By adding new sponsor group companies to the real estate development, management, and operation businesses, we will build a stronger value chain. In the asset management business, which is at the core of the value chain, we aim to grow the real estate assets under management of the group, including United Urban Investment Corporation, from approximately 1.8 trillion yen to 3 trillion yen by fiscal year 2030, reaching a top-tier level in the industry. We plan to achieve this by leveraging the group's assets and value chain. I will now explain the details of our financial results for the 43rd fiscal period based on the material. Please turn to page 10. DPU for the 43rd fiscal period reached a record high of 4,010 yen, driven by the effects of asset replacement and improved profitability of existing properties, marking an increase over both the previous fiscal period and the forecast issued 6 months ago. During the period, we implemented asset replacement through the acquisition of 4 properties totaling 10.95 billion yen and the disposition of 2 properties totaling 11.40 billion yen, aiming to improve the quality of the portfolio and reduce the average age of properties, while realizing gain on sale of 0.52 billion yen. In terms of internal growth, the expansion of hotel earnings driven by increased inbound demand served as the main growth driver, while revenue improvement from the replacement of retail properties also contributed to an increase in revised NOI. Additionally, we boosted DPU by 18 yen by acquiring 1.9 billion yen worth of our investment units. Going forward, we will continue to pursue DPU growth through further improvements in portfolio profitability. Please refer to page 11. I will talk about the main factors of the difference between the DPU for the 43rd and 42nd fiscal periods. DPU for the 43rd fiscal period reached a record high of 4,010 yen, an increase of 73 yen, or up 1.9%, from the 42nd fiscal period. Specifically, net profit of Kawasaki Toshiba Building, shown in the third column from the left, caused a decrease of 374 yen due to the cancellation penalty received from a tenant departure and the drop of gains on sale. However, this was covered by net profit of dispositions, turning in an increase of 158 yen from gains on sale from asset replacements and net profit of existing properties, coming in an increase of 244 yen from increased rents at existing properties. Within the increase in rents at existing properties, the hotels maintained high performance with an increase of 183 yen. Profit from new acquisitions, shown in the second column from the left, came to an increase of 83 yen and helped bolster DPU as well. As for other factors, an increase in interest expense due to rising interest rates of 38 yen resulted in a decrease of 56 yen in sales administration expense, non-operating profit and loss, and other expenses. The effect of the acquisition of our own investment units came in at an increase of 18 yen. Please turn to page 12. I will now explain the main factors contributing to the year-on-year changes in performance forecasts for the 43rd fiscal period and the 45th fiscal period. For the 44th fiscal period, we expect DPU to reach a new record high of 4,100 yen, an increase of 90 yen, or 2.2%, from the previous fiscal period. This is primarily due to an increase of 134 yen from the contribution of newly acquired properties, as well as an increase of 242 yen from the disposition of the Hirakata Nago Logistics Center and the Miyamai Shopping Center. On the other hand, in sales administration, non-operating profit and loss, and other expenses, the main factor is a decrease of 57 yen attributed to interest expense due to rising interest rates, resulting in a total decrease of 124 yen. For the 45th fiscal period, we expect DPU to reach a new record high of 4,200 yen, an increase of 100 yen, or 2.4%, from the previous fiscal year. However, there is a decrease of 306 yen due to the drop of gains from the sale and profit of assets. On the other hand, the profit from existing properties is expected to increase by 532 yen due to the receipt of variable rent from hotels on an annual basis and the cancellation fees from Shinsaibashi Opahankan, resulting in an overall increase in DPU. Next, I will provide an explanation of the asset replacement. Please refer to page 13. This page explains asset replacement in the 44th fiscal period. As stated in our medium-term growth strategy, we will accelerate asset replacement during this period. In asset disposition, we aim to rejuvenate our portfolio to improve profitability and quality. We plan to achieve this by selling properties with concerns for future profit and those with older building ages. In addition, by disposing of properties above their appraisal and book values, we expect to secure gains of 1.22 billion yen, which is expected to boost DPU. Acquisitions in the period are two variable rent-type hotels located in the Tokyo and Osaka areas with high inbound tourism demand, where further income growth is expected due to inflation, and one healthcare facility that ensures stable income, with a total acquisition price of 14.4 billion yen and an expected NOI yield of 4.7%. With awareness of the implied cap rates, we can acquire properties of different asset types based on our investment policy of a diversified rate. We will continue to expand our AUM by leveraging the acquisition pipeline shown on page 4 of the presentation material, as well as the information network and enhanced new sponsor function of the asset management company. The asset replacements that we will conduct in the 44th fiscal period are expected to lower the average age of our portfolio from 30 to 10 years and improve its quality, with the NOI yield increasing from 4.2% to 4.7%. And the adjusted NOI yield from 3.2% to 4.2%. Through such strategic asset replacements, we will work to realize unrealized gains and remove concerns about medium to long-term performance deterioration, while strengthening the earning power of our portfolio and improving its quality. As such, we will exercise sustainable growth to increase our unitholder value and return gains on sale. Next, I will explain internal growth by property type. Please turn to page 14. This page covers the operating status of hotels. As shown in the upper left graph, RevPAR for the 43rd fiscal period reached the highest result of 11,996 yen, up 4.5% from the 42nd fiscal period, mainly due to an increase in ADR. RevPAR is expected to continue its upward trend in line with the improvement of ADR. The upper right graph shows the RevPAR of variable rent hotels by region. In the 43rd fiscal period, the increase in domestic travelers, coupled with robust inbound tourism demand for accommodation centered in the Tokyo metropolitan area and Osaka area, significantly contributed to the results. Moving forward, we expect that a further recovery of regular international flights becomes in line with Japan's inbound tourism policy, which is shown in the bottom section. And as a result, we expect that it will lead to an increase in demand for accommodation in Okinawa and other regional areas, and to an increase in RevPAR, which contributes to profit. In the 44th fiscal period, we anticipate RevPAR in the Osaka area rising thanks to the Expo 2025 Osaka, Kansai, which officially opened in April 2025. Furthermore, in the Okinawa area, RevPAR is expected to rise further due to the steady growth of domestic visitors and the full recovery of inbound tourists. Page 15 shows the breakdown of rental income by hotel type and the GOP ratio relative to sales. As shown in the graph on the left, rents on an annual basis reached a record high as RevPAR rose. Our forecasts include an increase in variable rents for hotels located in Tokyo, as well as rising rents in regional areas, including Osaka and Okinawa, which we expect to reach a new record high. The graph on the right shows the GOP ratio in relation to sales. Since the 39th fiscal period, when the hotel market began to recover, an increase in ADR above the increase in cost contributed to improving the GOP ratio and helped to raise rent. Page 16 shows the operating status of office buildings. We maintained a high occupancy rate by implementing active tenant replacement. In the office markets in central Tokyo, while some properties have struggled with leasing due to the supply of large-scale new buildings, as shown in the bar chart on the left, the occupancy rate of United Urban's office portfolio remained high at 98.4% at the end of the 43rd fiscal period. Despite the vacating of large tenants at some properties in the 43rd fiscal period, replacements were found soon through agile leasing measures, continuing the high occupancy rate. The right side of the page shows the post-acquisition management of Osaka Bay Tower, where both occupancy rate and rents have significantly increased compared to the time of acquisition. Leveraging our management capability as a diversified REIT, we have achieved rent increases through active leasing measures, such as reorganizing leased areas, converting common space into rental units, and repurposing spaces for other uses. Page 17 outlines the rent increase and decrease, as well as the rent gaps for office buildings. As shown in the rent increase-decrease graph, in the 43rd fiscal period, we achieved rent increases exceeding the previous period by leveraging high occupancy rates on the back of rising office demand. We have replaced tenants and revised rents upward at the time of renewal at many of our properties by negotiating contract terms and conditions based on detailed market analysis and rent assessments and identifying needs for expansion. Rent increases in regional properties have played a key role in driving growth. In addition to the high rent gap in regional properties, the rent gap is expanding in urban areas with the increase in market rent. Going forward, we will focus on rent increases and renewals tailored to individual tenants in urban areas, leveraging this rent gap. Page 18 shows the operating status of retail properties. We have maintained high occupancy due to the implementation of strategic tenant replacement, with the occupancy rate standing at 99% at the end of the 43rd fiscal period. While some large tenants vacated certain properties during the 43rd fiscal period, we expect to keep occupancy at a high rate with a recovery in rented area in the following period. The upper right section of the page shows the rent revenue and facility sales from Molera Gifu, which was acquired in the 42nd fiscal period. In an inflationary environment, we introduced commission-based rent and increased existing rates to capitalize on the upside potential of rent increases, thereby achieving growth in rental income. Over the next year, many tenants will be renewing their leases, and we will continue to actively negotiate for increased rent. The lower right section of the page outlines our plans for Shinsaibashi Oppa Honkan following tenant departure. We have sounded out good offers from multiple companies and are considering sale, exchange, and lease. Going forward, we will narrow down candidates for sale or exchange as the primary options and decide on the final plan as soon as possible. The gain on sale will be returned to unit holders in the event of a sale, in accordance with our asset replacement policy. Page 19 outlines the operating status of residential properties. We have been able to achieve stable operations with high occupancy, mainly for residential properties in the Tokyo metropolitan area and family-type properties. Rental demand for family-type has been on the rise due to the prevailing price hikes in condominiums. This high demand, along with reduced supply, are the reasons why rents are on an upward trend and why we have been able to increase rents at the time of lease renewal and tenant replacement. We expect this trend to continue. As shown in the pie chart by unit type on the right, our residential portfolio is attractive to a wide range of demand, from singles to families. We expect continued stable operations of residential properties moving forward. Next, we will discuss financial management. Please turn to page 20. As shown in the upper left-hand corner of the page, we raised 22.7 billion yen in the 43rd fiscal period. While market interest rates have been rising, we focused on avoiding an increase in funding costs and funded a certain amount from short-term borrowings and variable rate loans. Although we have been conscious of cost containment, funding costs for the period slightly increased from the previous period. We maintained total asset LTV in the mid-40% range and fair value LTV in the mid-30% range, ensuring sufficient capacity for acquisitions. As for the impact of interest rates rise, we forecast an interest rate rise once in each of the fiscal periods for the 44th and 45th, as shown in the lower right-hand corner of the page. We will continue to maintain a stable financial base by controlling financing costs through flexible fund procurement. Finally, page 21 of the material summarizes our ESG initiatives and efforts to address climate change. We have decided to introduce off-site power purchase agreements, or PPAs, for several properties to promote the use of renewable energy. By ensuring that a portion of the electricity used in our operations comes from renewable sources, we will promote decarbonization. Moreover, we have revised our sustainability policy and added 3 new commitments, including a target for net zero emissions, to strengthen our stance on climate change. We will continue to promote efforts to achieve the new targets and reduce financial impact. For further details on our ESG initiatives, please refer to the appendix. This concludes our presentation. Please refer to the appendix for details on financial results, forecasts, and operational status. Thank you very much for your attention.